Microsoft is undergoing one of the largest business transformations of any business ever. In fact, CEO Satya Nadella has talked about how software apps can potentially collapse. That means go away entirely. And of course, they are a software company at their core. Now, they have a $70 billion profit pool that is now at risk. And in addition to that, AI opens up new vectors of competition. And even their lauded cloud Azure business is potentially at risk here. There's all sorts of things changing under the hood at the core foundation of the Microsoft business that I don't think investors are talking about. Investors have taken a new attention to Microsoft, given, the 23% stock sell-off in the past 6 months, while the market has been rallying up about at least 10% for the NASDAQ, depending on what day you're watching this video, that is. But I think investors are missing the bigger story on how much this business is changing and is really cannibalizing itself in order to become a future AI company. In fact, this isn't me making these hyperbolistic statements. It's the CEO himself who's talked about we no longer are a tool company for end users. Instead, we are going to become an AI first company. They even talk about how their pricing model is not going to be based off of humans, but based off of AI agents. And so there's a lot of changes happening in this business model. And with the stock trading at 25 times trailing earnings, investors are wondering, what is the opportunity here? And so we will talk about all of that in this video here, in addition to different elements of the business, different risk I just don't hear many people talking about at all. And so not that there's any way we can really kill a Microsoft investment thesis, because Microsoft, let's face it, almost no matter what you do, it's going to be around. But if you're looking at it on a free cash flow basis, it trades at 46 times free cash flows. And so one, why is there such a big difference between free cash flow and earnings? What is a better sort of way to look at the business to value it? We'll talk about that in the end. But the second thing is, when you're talking about a stock trading at a 46 times cash flow multiple, there's a lot of expectations embedded in that need to happen in order for an investor to make a return. So we will break all of this down in this video. Now, the fear with Microsoft stock is that they could have a lost decade. If investors are assuming too much greatness can happen from AI, maybe very similar to all the developments they thought that would happen during the tech bubble, they may be overpaying for the stock today. Now, I'm not going to claim the stock's valuation is anywhere near as extreme as it was back then, and there's many ways we could look at the valuation where things can look quite attractive, and we'll talk all about that at the end of the video. I just want investors to be aware that there is a widening distribution of outcomes as they undergo this transformation, and so we will contextualize all of that in this video. Now, the way this video is structured is, first, we'll start with just a very brief overview of the business segments. If you're familiar with this, go ahead and skip that. There's timestamps below. Second, we're going to get into competition. This is going to be more traditional competition that's existed. It's going to be quick, because then we're going to get into the third section, which is transformation, how things are changing for them. Followed by the fourth section, which is the key question investors need to be confident in this company. This is the only thing that actually could kind of kill a Microsoft thesis, basically the whole business. And this is not me saying that. The CEO himself had said that. And so we'll talk about that key question. And then the fifth thing we'll get into is the DeepSeek and fiber risk, something else that's worth exploring. And then we'll move into this key accounting issue that is really important. And it's the reason why earnings look so different than cash flow. We need to talk about this because this is mathematically going to be an earnings headwind for them. This is not a forecast. This is just the actual way accounting works. This is going to be a headwind to earnings going forward, period. It's not up for debate. So you need to be aware of that issue. And then finally, we're going to conclude with valuation, put some numbers around all of this. And so we have a very informational, heavy video packed with a lot of things investors should be aware of if they're interested in Microsoft. But you might be wondering, why should you listen to me? Who am I to talk on all of these issues? And so my name is Drew Cohen, and I used to work at Goldman Sachs in investment research. And then I worked at Capital Group on the buy side, helping manage billions of dollars, covering a lot of different sectors, including technology when I was there. Now I am a registered investment advisor, but I also run Speedwell Research, which produces in-depth research reports that we sell to hedge funds and asset managers. We have over half of all of the top 50 50 hedge funds or asset managers as a client of ours in that business. And so I talk to a lot of professional investors aware of a lot of issues and all that and what goes into deep research. Now, these videos take a long time to make. You're talking, about 50 hours of research production and all of that. So I just ask, if you are enjoying these videos, you go ahead and hit like and subscribe so we know to continue to produce content like that. And it's worth mentioning, in the research process of this, Microsoft's a big business and understanding technology can get very complicated, especially as we get into novel and new technical risk that have never existed historically. And we're getting into new areas that, let's face it, no one really knows what's going to happen in the future. And so while I'm going to surface a lot of risk and a lot of my thoughts on this, but you have to understand I could miss things because as this gets more and more technical, there's more areas that it's harder for sort of a layman, investor to understand all of these issues. And so I really do my best of trying to understand the technical issues, making them simple and bringing them to you. But there's also a reason why we should keep in mind that Warren Buffett did invest in a lot of technology stocks, even ones that he thought he understood, because he always worried there was a risk that maybe he wouldn't have missed. He didn't know what he didn't know. And so that is kind of a disclaimer as I try my best to give you as much information as possible to touch on the more technical aspects of the business and not shy away from them. But it's also just sort of a disclaimer that it's possible I missed things. And so if I did, go ahead and drop it in the comments below and maybe we could talk about it in the future. Now, let us get into a quick overview of the business. So they have $305 billion in revenues. These are going to be LTM numbers I'm giving you here. So the last 12 months. So $305 billion in revenue. That is growing 17% year over year. They have $142 billion in operating income. That's growing a little bit quicker, 20% year over year. And so that is a 47% EBIT margin, which is really quite crazy, just given the scale of the business and how much they've been growing. And growth has actually been pretty strong the last few years. They've continued to put up that mid to high teens growth number. So that's been mostly driven by these first two segments, with this third segment, the more personal compute segment, kind of a laggard. So the first segment is going to be productivity and business process. This is going to be 130 billion of revenues and 77 billion of profits. Now, when I opened up this video by saying that there's this 70 billion profit pool that is at risk, it is this one, because this is where they house all of their software. And there's also LinkedIn in here. That's not a risk in the same way. That's probably actually a beneficiary, but it's a relatively small business. So my estimate, roughly $70 billion of profit from just the software, from the Microsoft suite, the subscriptions, all of that, both for the consumer and the commercial. That is what's at risk, as we'll talk about in the AI section. So that is a lot of profits they're going to need to replace if it is the case that people do end up using their productivity software less. And so not going to say I'm convinced that's going to happen. A lot more to say on this in the AI section, but in this segment, it's going to be those subscriptions. It's also going to be stuff like OneDrive, which people will pay for extra storage. That's their kind of cloud storage solution. Then they also have LinkedIn, which I briefly mentioned, that monetizes through advertising. There's also subscriptions for recruiters to message people. And then there's lastly going to be Dynamic 365. This is a business maybe you're not as familiar with because it's on the enterprise side. And so this includes everything, including CRM, customer relations management, CDP, customer data platform, ERP, enterprise resource planning, stuff for finance, supply chain management, inventory, all of that. And so if maybe you remember from our ServiceNow video we talked about a lot of these functions, how ServiceNow is getting into all those. And so it's kind of interesting as we research all these businesses, we could get more kind of a bottoms up understanding of how they all work together, how they compete against each other. And so this is a competitor to not just ServiceNow, but also mostly kind of the legacy players here, which is going to be Oracle, SAP, and then also a little bit more later, Salesforce. And so this is back-end sort of business process stuff for enterprise. I'm mentioning it here and spending a moment on it because this is going to be a layer that's really important when we get to AI, because you can imagine with AI doing more and more business functionality, this kind of Dynamic 365 and something called the Power Platform, that is their position here that entrenches them more into these big businesses, into enterprise. This is something that also, by the way, helped them leverage more Azure sales and will also help them leverage in the AI world. So that's why I just wanted to spend a moment talking about that. Now, this segment in total, I already said, was 77 billion in operating profits and is growing at about 11% year over year, which is a little bit quicker than their top line growth in the segment of 8%. One of the most important segments they have, followed by the second segment, which is going to be intelligent cloud. This is going going to be Azure in here, but I'm going to break it up a little differently. I want you to think about it as being infrastructure as a service. Not sure how to pronounce that acronym, IaaS. Either way, IaaS, that is what this is going to be. And that's the actual hardware of cloud. That is the actual data servers that exist there that people are renting out. So it's like you're renting out a virtual machine. So instead of, a company when they go to get a cloud service, they don't rent out, give me server racks 17, 18, and 19. Instead, they rent out an amount of compute that becomes a virtualized environment. So a virtual machine that doesn't really exist because this virtual machine could exist anywhere in their server architecture. And so that is the infrastructure layer. On top of the infrastructure layer, that's going to be PaaS, or Platform as a Service, or PaaS. And so this is going to be one layer up in abstraction. And I'm going to explain this a little bit more in detail, give you an example on this in a moment, but just put a pin in it for now. So there's infrastructure as a service, platform as a service, not software as a service. That doesn't go here. That goes in the prior segment. That's going to be the Microsoft 365 suite. What else goes here though is their AI solutions, their security tools, identity. There's also going to be Windows Server. They still have an on-prem business. People are still loaded up on servers that are not on the cloud. It's in enterprises and businesses own servers that exist in their business, often running Windows software because that's how it was a long time ago. And that's part of their position in Azure too, is that they're able to transfer these clients over to the cloud or a hybrid cloud where they can have on-prem and then also public cloud loads running across both of those different vectors. And so that's in this segment. There's also GitHub, which is their coding, low code platform. And then Nuance, which was an acquisition, gets them into healthcare AI, and then other sort of AI services fall in here too. And so this is intelligent cloud. It's been growing 26%, $120 billion in revenue now, operating income of $50 billion. So a little less than the software side, kind of important to take a note of that. And that $50 billion last 12 months has been growing about 13%. So this segment, a little bit of a lower margin at 42%. Now this last segment, we're just gonna touch on real quick. A lot of businesses I think people kind of forgot they even own in here, or businesses that they're in. And so this is the more personal compute. This segment in total actually has a good amount of revenue though. It's 55 billion in revenue, but it's only growing 4%. And that 55 billion in revenue is only giving them $15 billion in operating profit, which is growing a little quicker. It's growing around 15% for, a total operating margin of 27. That is this segment. What's in here? Windows licensing. That's, the historic business, the Windows OS system. That's a higher margin business. But then there's also Xbox. There's the Activision Blizzard acquisition, all the games in there, Game Pass, all that. People not talking about that one much anymore. There's also going to be their hardware business in here, their Surface tablets. In addition to that, you're going to find their search business, which is Bing, of course. And then also they own MSN, which, their browser kind of opens up to show a bunch of ads there. So have a little bit of an ad business. So we're not going to touch more in this segment there. You should be aware it still exists. Maybe there's some, upside in Game Pass working, the gaming and all that. Generally speaking, it hasn't really been that great of an acquisition for them. They didn't pay that much of a price, but they really haven't accomplished their ambitions there of trying to get, a Game Pass of Netflix basically for video games. So putting that aside, because the real story is going to be the software stuff, the AI stuff, and cloud. And so that's what we're going to focus on. I'm going to say a few words on competition before we get into all the fun stuff, the business transformation. So in terms of competition, you got the big three we all know about between Google, Microsoft, and Amazon. You also have Oracle kind of within the mix there. And then you have, kind of newer players like CoreWeave. That's kind of an interesting one because Microsoft is actually one of the biggest customers of CoreWeave. And they did that basically because they didn't have enough GPU data centers. And so they contracted out to them in order to fulfill commitments, probably for OpenAI, in order to kind of service them as much as they needed to be. And so in addition to that, you have some companies that are still in hybrid cloud. So they'll do on-prem servers for a certain amount of their compute, and then they'll work with someone like Microsoft for the rest. That's a little bit of an advantage for Microsoft because they are pretty entrenched with a lot of legacy sort of on-prem servers. So was Oracle, by the way, too. And so that's kind of a benefit for those companies because if you're on-prem, you have all your data. It's a little easier to do a mix between that on-prem and then that provider's public cloud. And so that's kind of just in a nutshell there. In terms of actually competition, why someone picks one cloud provider versus another, well, the infrastructure layer, it's kind of commoditized by and large, and it comes down more to this platform layer, the kind of developer tools that sit on top of the infrastructure. And if we go to, Amazon, they've been pretty good at coming up with stuff like S3, Lambda, these different tools that developers adopted became pretty popular. This was early on. Of course, now there's lots of copy products all across. There's not really that much of an advantage, but you do build up a reputation for being, better or worse. Microsoft, for the most part, is kind of seen as being a fast follower, if you will. They're not so behind on all the tech, but they're not going to be, the most innovative, but they do a good enough job. They really win a lot because they have relationships that are pretty entrenched with a lot of these enterprises. Maybe you use them for Microsoft 365, for Dynamic, your CRM or ERP system. And then it makes sense to go ahead and just use them too for your cloud. And so Google is kind of the newer player. They really didn't have a presence at all 5 years ago. Now they're winning a lot. They have one tool called BigQuery that's pretty popular with database, and that's also at the platform layer, but it's also allowed their AI tools and features, and they're seen as being, kind of very tech forward with all that. So that's why a lot of startups will kind of pick between AWS and Google, whereas Azure is winning more with these legacy enterprises, older businesses that have a lot of kind of pre-existing systems. That's on cloud. On Microsoft 365, biggest competitor, simple, it's Google Suites, Google Workspace as it's now called. The free document sheets, Google Docs, all that. A lot of startups, they'll use the Google sort of Workspace for free, stay on that network, never even touching Microsoft. Of course, though, plenty of people still on Microsoft, even though it's this very old app that doesn't seem to change much. And if it does, people will get upset, which is exactly the kind of product you want. But, it continues to do very, very well, get a lot of sales. It can't really be replaced easily. At least me personally, I use Word whenever I write anything up. I use Excel. I will not touch Sheets for any financial analysis. And so that's just a lot of people pretty similar to me. And so it's a pretty sticky product. That's why that's such a good high quality business for them. That's their software suite. And then you get to Dynamic 365, kind of the enterprise tools in the back ends kind of stuff we touched on, ERP, CRM, customer data platform, all that. Again, the competition there, that's going to be SAP, that's going to be Oracle, that's going to be Salesforce, and some new players getting more into those lanes like ServiceNow. Then we move down to other competition, like in cybersecurity, you have CrowdStrike, and you also have Palo Alto Networks, and then there's, other sort of players in there. And then in search advertising, you have Bing, of course. Bing competes primarily with people who are not aware that they're not on Google. And so they do have a little bit of a search business there still. They have their own browser. You open it up, its default is Bing. There's all sorts of shady ways people try to change their default browser to Bing, or sometimes Yahoo search. I'm, on my PC, for whatever reason, it keeps telling me that Google is unsafe, and it auto changes it to Yahoo search. And so it's a very similar kind of Bing sometimes. That's how they get a little bit more shared, through kind of distribution means like that. And so that's the other business there. And then, they have some advertising too on MSN, which they own. It's also like a default page for their browser. And that's kind of the business in the nutshell. They don't necessarily do any one thing the best, but they do so much and they bundle it together, and it's usually cheaper to buy the bundle than the individual point solution. That's why they continue to win, and they've always had a great big sales force, and they're just everywhere. And so that's them in a nutshell. Let's move on now to talking more about how competition is going to change. This big business transformation that's going on. This is now where things get more exciting, to be honest. We had to get all that out of the way just to kind of catch people up, make sure we're all on the same page. But now let's get into the fun sort of elements where we talk about how AI is changing the competitive landscape. Okay, so let us get into this platform as a service risk I was talking about. So the platform as a service is basically gives developers a lot of tools to do sort of higher level abstractions, or gives them pre-built sort of features that they can incorporate into their software. So for a very clean example, let's say that you want to build sort of the ability to log into a software app. You could do this the old school way, which we'll call, the hard way, which is you do it at the infrastructure layer. And so instead of using this platform as a service layer, you build your own basically user login management system. You build your own password database, your own ability to retrieve all of the passwords, to check them, to do security, to do single sign-on, to do multi-factor authentication, all of these sort of elements involved in creating a login system. You recreate it at like the root most basic layer that works with the infrastructure, with the databases and all that. Instead, though, of doing all that and taking all those efforts and steps, you could use Microsoft Entra ID. And so this is something at the PaaS layer that a software app can include in their software. They could just call up Microsoft Entra instead of having to rebuild all of this stuff that's already been built many times before. That gets used a lot. And so now you could start to see how this can become very sticky, because if you have something at the software layer that is calling up something at this platform layer and incorporating it into your software, then it's very hard to change anything in your software. And so what ended up happening when a business picks a cloud provider is they start building all of these tools on top of the platform layer that then gets incorporated into the business, into the workflow process. And then it makes it very hard to change any of this out in longer term. And so that is why once you kind of get stuck on a cloud provider, it's pretty sticky. That's how they're able to maintain the margins they're able to maintain. This is really important to understand, this platform layer, because it's at risk of collapsing. So you have the infrastructure layer, you have the platform layer, you have the software that sits on top. Now, what is happening now and what is at threat with AI is the platform layer is basically collapsing. You no longer need it the same way you once did. And so let's say you have an AI agent that you tell to do something. It doesn't need this higher level abstraction that the platform layer offers. It could go directly into the database and just do it itself. It doesn't need all that. And so just kind of an example, let's say you want to see how much inventory a business has. Well, before, you had software that would work with all of these different platform layer sort of abstractions, and it would segment the databases, and maybe it had some sort of analysis and analytical tools it was calling on, but the user was using the software interface to find out, how much wood planks do I have in my warehouse. Now the AI doesn't need any of that. The AI can collapse, basically go through the platform layer. It doesn't need that. It could go directly to the database, just look at everything there, count it, come up with an answer, and come back up to you and give you that answer. And so that's why a year ago, when CEO Satya Nadella was on the BD2 podcast, he talked about how a lot of software is going to collapse. A lot of it is going to go away, and it has to do with this reason. He basically thinks of most software as being CRUD plus business logic. And CRUD is basically create, read, update, delete. And so when you have an AI agent, it is able to create its own logic. It doesn't need the logic of these software layers. It doesn't need the sort of help that the platform layer provides. Instead, it just goes through all of that, could go to the raw database, come up with its own logic, do its own thinking basically, and then come back to the user. And so it disrupts this entire flow. Now, you still need the infrastructure, obviously, but you're not using the platform layer, and now the software is going away. And remember, I said one of the stickiest, most competitive sort of advantages a cloud provider has is the platform layer and the fact that the software builds off of the platform layer. Now you can see where we're going with this. With an AI agent, it circumvents all of this. It doesn't matter what existed before. It could go all around this entire sort of stack that was built previously. And this is why, frankly, that we're talking a lot about software selling off. This is why it's scary, because an AI agent doesn't need the software. It could go around this whole thing. And even though, especially on this channel, we talked about ServiceNow, Adobe, Constellation Software, we talk a little bit about why these companies may still exist, why they're not totally going to be, let's say, screwed by AI, but there's going to be some companies that really do go away. It's not this case where there's smoke and there's absolutely no fire. There's going to be destruction in software. The question is which businesses, which ones have some sort of insulation and competitive advantage. Now, we talk about how Microsoft has a 70 billion profit pool right now from software. Okay, this is a scary position for them to be in, and the CEO is talking openly about software going away. That is why they're transforming their entire company to be AI first. They need to replace most of this profit pool. We don't know how much. Some of it could go away because we don't really know how much software is going to be used in the future if everything becomes more efficient and AI can do a lot of the things we traditionally relied on software for. So quick example, let's say before you wanted to sum up the accounts payable from, a selection of vendors in Brazil, you go to Excel, you go ahead and you type everything in, you maybe are exporting data into Excel, you're adding it all up. Maybe you have to make some sort of adjustments for currency. Maybe there's some people that already paid you back. You got to go ahead and fix that. And then you get your number. You're doing this all in Excel though. Now you just ask an AI agent, it goes right to your database. It could collect all the data it needs. It could come up with an answer and just give you that. You may not even need to go into Excel at all in order to get that answer. And then it makes you wonder, well, what do you actually need Excel for? Well, how many jobs are going to be replaced by just AI? And this is where things start to get scary. We're on uncertain ground. We don't really know. But as AI gets more and more powerful and it's subsuming more and more of these workloads and it's able to do more and more, why do you need to go into Excel at all or Microsoft Word? And how many employees do you even have anymore? If there's fewer employees and they're charging on a subscription per seat basis, then doesn't that mean there's less people buying the software, less people using it? This is not just me saying these fears. This is what the CEO out loud has already said. And I just don't think people are fully appreciating what it means for a business to go through this level of transformation. It's like doing, open heart surgery on someone. This $70 billion profit pool is going to shrink eventually. We don't know over what period of time. And their saving grace and the thing they're hoping for is that now they sell software subscriptions to basically the AI agent. And so this is what Copilot is in part, but they have other initiatives there. Unfortunately, Copilot's not that useful yet. It only has 3% penetration so far. Maybe that's to the benefit because that means there's going to be more software usage for a longer period of time. But it could also mean that, a little bit of a risk to how well they're going to weather this transition, because maybe it's not, AI plus Microsoft people use. Maybe it's a different company's AI. We'll touch back on all of that. I just want to lay out all of these thoughts first. And so this is kind of the first risk that really exist here, is that with the AI agent, you have less software usage. Less software usage means less seats that you're selling, and so fewer software subscriptions. Right now, they're trying to offset this by saying we're going to increase the price of the subscription if it has AI in it, so that'll give us a little bit of an offset. And then we're also going to sell tokens, so the more usage of AI, the more revenues we're going to be able to generate. It's worth considering, though, who's keeping the economics of these sort of tokens. And we touched on this in the ServiceNow video. It is a key thing you need to think about, because what's happening is basically the value of the old product used to lie with Microsoft. Microsoft created Excel. They were capturing the value. Now the value is not really Microsoft as much anymore. Now it's whoever is the model owner. Let's say it's Anthropic. It's Anthropic's AI or OpenAI's agent that is going through and doing all these functionalities. Guess what? They're going to want a margin for it. They're going to say, you're using our AI agent, we're going to charge you for it. Now, this scenario is not far-fetched at all. It's already kind of happening a little bit. Margins on, we don't have great sort of data on this because it's a private company, but they're reported to be 60% gross margins on inference, which is you have training when you're training the model, inference is when you're actually using the model. And people thought that the AI model companies wouldn't be able to maintain such high gross margins. Well, they're kind of already there, and who knows what ends up happening if the competitive environment changes and there's less capital flowing into all these different AI companies, which means some of them are no longer going to have that much funding and they get even more aggressive with pricing with their partners, and they could all do that in unison, much like a lot of other industries do. When capital kind of dries up from them, they tend to rationalize competition. Right now, AI is in this phase where everyone's just fighting for market share. This is the first phase. The second phase is the market share stabilizes and then they focus more on monetization. We saw this very recently with Uber Lyft. Both of them are now cash flow positive after years of fighting each other for market share. We could see something similar here. Now, these are hard things to think about because you're talking about a 5-year thing, maybe a decade. We don't know because AI is still in the land grab phase. They're still doing a lot of work and still improving these models a lot. So we don't really know exactly where it's going to go. Now, there's a second risk here too, though, with AI. And the second AI risk has to do with the infrastructure layer now being more important. So one example we could think about is if you're training a model, let's say Google trains their model, it works better on their TPUs. Amazon also has their own chips, Trainium. It's not quite as popular yet, but they still have a lot of efforts to catch up. And Microsoft has their own chip, but it's kind of a laggard. It's really not that popular. It's not really up there. They're mostly relying on NVIDIA's GPUs. So what happens at the infrastructure layer, though, if, let's say, a model company prefers Google TPUs? Now Microsoft is at a structural disadvantage because they only have NVIDIA's GPUs. Right now, this is not a problem because NVIDIA is still, a leading GPU. They're doing great, and no one really thinks they're imminently at risk of becoming irrelevant or becoming superseded necessarily. But it's also not impossible. There's other chip designs we find out are better for different workloads. And if that happens, you have to either spend a lot of money to build that out, or if it's a proprietary solution, it's just an advantage that, say, Amazon has over them, and that's the end of story. Now, it may not be a kill case for them, but it doesn't mean their infrastructure is not as fungible as it was before. Satya Nadella talks a lot about fungibility of infrastructure, but a CPU data center is very different than a GPU first one. And if there's other chips like TPUs that come into the mix that they need to buy in order to be competitive, that just changes more and more their ability to swap out different workloads to increase their utilization at a given time. That's another sort of layer of competition that's changing. Now, the infrastructure layer could matter more than it did historically. So the platform layer is going away. That's decreasing the stickiness. At the same time, you have companies that are caring more about the infrastructure layer. That could be another thing that gives someone a leg up versus someone else. Now, we get to this key question that really has to do with the fate of Microsoft. This is actually the only existential risk that exists in the business that at least I can see. And this is not me saying this is the CEO saying it too as well. And that is, if there's one AI provider, one model provider that is so superior and just wins AI and it's better than all the other ones, then that means they're kind of going to be screwed, because that one company can basically control the entire market. If that AI is so much better, you're talking about one AI getting to super intelligence or godlike AI, whatever it is that you want to call it, and they're the ones that are just so superior to anyone else and they're the best, then every company is going to want that. They're going to be able to demand whatever they want. They're going to be able to build out all of this functionality, the sales force, the distribution. They'll be in that position to win any deal they want to win. And so if that was the case, where you're looking at one AI models that's so much better than anyone else, then it really would be bad for Microsoft, because you wouldn't need them, because that AI company can do the AI agents. It could go around the software, the platform as a service. Maybe Microsoft exists as an infrastructure provider, but that's not that high margin of a business. And so that is the real big bear case scenario. I don't think that's going to happen. It doesn't look like that's happening. If you rewind, and right now they're getting a lot of criticism for tying up so closely with OpenAI. I actually think Satya Nadella played this AI game kind of perfectly, because the reason why they had such close ties with OpenAI and why they're loosening them now is not because they bet on the wrong horse or they're worried about OpenAI or something. It's because when they were that closely integrated with them, there were no other sort of AI options for them. There wasn't all of these open models that existed and competition existed. There was no Anthropic, Mistral, Cohere, Meta's Llama, DeepSeek. None of that existed. And so if AI was going to become a thing at the time, it was, well, Google's spending a lot of money on this. They're probably pretty far ahead. What are we going to do if something ends up happening with that? And so that's why they bet a lot on OpenAI. OpenAI looked like a great bet. It still is a great bet, by the way. They're not that much behind. But the real thing that they needed to do was secure a position in AI. Should the world go away of all of the models being closed, people not sharing them, or there being one model that's so superior, and they needed something to kind of answer to that to hopefully catch up. So that world doesn't look like it's happening. All of these models are sharing, they're partnering. A lot of them, even if they're a closed model, they're still partnering with other people to allow them to use that. So Microsoft now has the ability to integrate. You're talking about not just OpenAI's model, but also Anthropic's. They'll also work with Mistral, Cohere, Llama. They could do DeepSeek if they wanted to, other open source models. They do partner with Google. It's a little bit of a different partnership, because to get all the full features and the best benefit, you do need to be on Google Cloud. That's how they're kind of competing to really use AI as sort of a competitive weapon. But Microsoft's going to be fine. For the average business, they don't need the leading edge model. They just need something that's good enough. And what's going to happen is, there's going to be these models that get better. Some of them are going to get better than the other ones, and then they'll catch up. And a business that, is just using it to, reconcile inventory or accounts payable, they don't need the leading edge model. They need something that's good enough. So Microsoft just needs the models to be commoditized enough that there's multiple options, that they don't have huge pricing power leverage over them, and they're good enough for whatever the capabilities an average business needs. Now, maybe Google does have the best model, and if you're doing leading scientific research or technology, you're going to need that all the time, and that'll be their luck. But again, let's say you're a shipping business and you're just using AI to help coordinate scheduling. OpenAI's AI, even if it's 6 months behind, a year behind, it could be good enough to do that. And both AIs, they're going to continue to increase and get better. And so the key question is, as long as AI is commoditized, AI doesn't matter at all, actually. What actually matters is distribution and who can use the AI. And Microsoft wants to be the one that is using the AI. And so they're incorporating all these AI features. Even though they don't have their own AI model that's leading edge, they're still the ones that are benefiting a lot from it by selling it to their customers. And so if AI is commoditized, AI doesn't matter. It's who can deploy the AI that matters the most. And Microsoft is in a really good position to do just that. And so their strategy is to basically embrace AI. It doesn't necessarily need to be OpenAI's model. It could be any model. You're giving users different choices, but you're really wrapping it up into deep sort of business processes, into workflow processes. And so as long as there is an AI interface that Microsoft owns, Their bet is it doesn't really matter what happens with this software seat shrinkage and potentially fewer people using the product. We'll still be able to charge for all of the AI we're using, for the advantages, for the efficiency, basically. And so that is why they're transforming their entire business to focus on AI agents, because they believe this is going to be the future. But keep in mind, this transition from this old model of seat usage to this new model where you're focusing on AI agents and you're charging per AI agent. It's kind of what Copilot is. Copilot hasn't been that successful yet, but as it gets better and better, this is where the business is really banking on in the future. You're paying for these AI agents, and then there'll also be tokens. For the more you use them, the more you pay. And so that's the transition sort of aspect of this business model. I think it's worth keeping in mind that while this happens, it's very possible you see seats shrink before prices go up. So you could see some dips in revenue, or it could be that it accelerates a lot and investors get really excited, and then the seat shrinkage happens afterwards and it slows down. Just be aware that there's going to be a lot changing in this business model. It's going to be quite the transformation. And so they're kind of well positioned to get through it, and it doesn't seem like this huge risk that it's existential, but it still doesn't mean that the financials can't get really choppy. And as a result, investors who are not aware that this is the transition going on and all these other factors and the competitive sort of landscape changing could get scared out of the stock. Because if you don't understand your business, then when it drops a lot, maybe this is the first time you're hearing of this AI agent thing and them no longer selling to as many humans and them being aware of that, that could scare you. And that's why it's important to be aware of all these things, even if you're still comfortable, owning it despite all of that. Or maybe you're not comfortable. That's for you to decide. But I want to get into this next risk, which I'm going to call the DeepSeek and fiber risk. Now, this risk in short goes like this. DeepSeek, if you remember, it's an open source China-made model that it turned out was like 10 to 20 times more efficient to run. And so anytime you run an AI model, you're putting a lot of power through it. It's using a lot of compute. This one was 10 to 20 times less. So it was a very light model, as they'll say. Now that matters because a lot of the models OpenAI was making, Google was making, they were heavier models and they required a lot more power and a lot more compute for results that maybe wouldn't be worth all of that extra power and compute. So what this is implying is that there's a way to make these models lighter that require less power and less compute. Now, when it was reported that DeepSeek could run these models 10 to 20 times more efficiently, NVIDIA stock dropped the most in market cap than it ever had. It dropped 17% or lost $600 billion in market cap. So the reason why was you're going to need less GPU chips if all of a sudden these models get way more efficient. So that was the reason why the stock reacted that badly. And then people kind of forgot about this risk because what ended up happening was OpenAI and Google, they got way, way, way far out ahead in terms of the model improvements. And so then it seemed like, oh, wait, we're actually going to need all of this compute and power, all those NVIDIA GPUs. Okay, we're going to assume NVIDIA GPU demand back up. But there's still always the risk that something similar happens again. And it could be a development even from OpenAI or Google themselves. If they're able to get the same sort of outputs with much lighter models, then what ends up happening is you just need less compute. You need less power. This is a problem if you are a business that is currently spending $150 billion building out your data centers and buying chips and hope that there's a high amount of demand for it, given all these AI workloads. And if it happens that now it becomes much more efficient, then you don't have the demand there to service. This was a fixed asset. And by the way, GPU chips are usually only good 4 to 5 years, maybe less. And so if you don't have that demand, you're not getting your return on investment. You just burned all that capital. And so that is one risk dealing with this sort of efficiency thing. Now, a lot of people believe that there's going to be a lot of AI workloads and the demand's going to eventually come, even if it takes a while. And I'm kind of on the same page, to be honest, that I do think that AI is very revolutionary, but that doesn't mean there's this time where there's a lot of excess capacity and the demand isn't there, and that results in pricing pressure or just losses. And so I want to talk a little bit about what happened with fiber optic cable in the late 90s, which was that the US spent over $90 billion on fiber optic cable. And in fact, the telecom industry in total spent an estimated $500 billion on building up telecommunication infrastructure, internet infrastructure. What ended up happening though was by 2001, only about 3% of this fiber optic cable was actually used. 97% of it was quote unquote dark. And that turned out to actually be a good thing long term for consumers, for businesses, because you had a lot of investors that basically just subsidized the creation of a lot of infrastructure. You know who it wasn't good for was those investors who spent a lot of money on fiber optic cable that was never used for a decade later, is basically what it took for all that extra capacity to be used. And this is a parallel a lot of people are talking about now with all this data center build out. You have Microsoft spending maybe 140 to 150 billion. You have Amazon saying they're going to spend 200. You got Meta and Google are also up there. Altogether, they're estimated to spend over $500 billion in capex in one single year alone. What about next year and the year after that? And almost by design, they say they're going to overshoot demand. That's actually something Satya Nadella has talked about, because he believes the risk of undershooting demand is so much greater than the risk of overshooting it. So they rather spend too much, have data centers go vacant for a while, knowing eventually they're going to catch up. Now, that quote unquote catch up period, though, it could be 3 years, it could be 5 years, we don't know. And during that time, you're basically having a lot of assets you already paid for that now start to become depreciated on your profit and loss statement with no associated revenue. It shows up with basically less and less earnings and margin pressure. And so you thought you were buying the stock, at a certain multiple, and all of a sudden a couple years later, they spent so much money on all this capex build out. All that depreciation is now running through the P&L, and the demand isn't there at the same time. So your revenues aren't what they thought they would be. That is a lot of pressure to earnings. And now all of a sudden it may not look like such an attractive investment unless you're willing to, look out longer term. And so that is a real risk to the stock. And it almost seems like by design, they're going to spend enough money before it's very clear they spent too much money. And the reason why they're doing this is because they're really, really worried that the demand for AI is too much and they can't capture it. And if they can't capture it, let's say Microsoft can't capture it, then a customer, instead of going to Azure, switches to Amazon or switches to Google. And if they go to them, they're basically stuck on that forever. And so they never have an opportunity to win that customer back again. On top of that, if they lose that customer's data now goes to Google, it goes to Amazon. Amazon and Google can make their AI better, can make their AI agents work even better. And so now they're getting a competitive advantage, a leg up on Microsoft. And so that to them is kind of like a death spiral, because you don't have the compute capacity to get the customer leaves, you lose the customer data no longer is there to help you get the AI agent to be better. Now in the future, people don't want to pick your cloud service because you don't have a good AI agent. That is what they're all scared of and why they're racing to spend so much money. But there's also very likely at some point, there's not the demand there for all the supply. And there's this good investing book called Capital Returns that basically says that there's a capital return cycle where capital enters an industry. What ends up happening is more and more capital enters it, the supply increases, the capacity increases, and it eventually overshoots demand. And then when that ends up happening, pricing falls. And so it's a simple model, and that's kind of one of the risks here, is that you have all of this capacity into data centers, into AI workloads to service them. Maybe the demand is less. Maybe it is in part because that DeepSeek risk we talked about models getting more and more efficient. And so now you have less AI workloads combined with the fact that you have all of this capacity coming online at the same time, and they're just ramping it up. You could get a lot of pricing pressure. And so that's a risk. Again, even if the demand shows up 5 years later, those GPUs could not be that useful by then 5 years later. So it's all a write-off. And so that's a risk. Now, is it a risk if you're looking at the business from a 20-year perspective? Maybe not, especially if AI is really going to be that big. And there's something called Jensen's paradox, which is basically the more efficient the model comes, the more it creates its own demand, right? Because the more efficient it is, the cheaper to use it, the more people end up using it. I don't really know why that's a paradox. It just kind of makes sense intuitively to me, at least. At a lower price, people are willing to consume more. But that's the idea there. And so even if the models end up becoming much more efficient, there'll be just more and more workloads that get consumed because it gets cheaper to do that. That's going to create its own version of demand and could actually be a benefit. These are two different views here, but if you're wondering if there's a risk that they're overbuilding, yes, there's totally that risk. And also there's a year after next year. If we think $500 billion is a lot right now, what about the following year and the year after that? They're going to continue to spend all of this money basically until they feel like they've more than safeguarded against the risk of them losing demand. And the only way they can do that is by handily outspending demand. And so the other aspect of this is the fungibility of the data centers, because you ask Satya Nadella about this and he'll say, well, even if it doesn't work out, there's not all this AI workloads, we could still use the data centers for other things. That's true, but not necessarily the GPU servers. That whole architect of a data center on GPU is really designed for AI workloads. There's not that many traditional CPU-based workloads that Azure has that can run that effectively on GPUs. So in that case, it still doesn't work out that well. They could find out a use for the data centers eventually, but that could cost more money to do that. So all of that is just something to be aware of. I don't know that this is like an existential risk for the company, but I don't think investors would be too happy if you're expecting many years of growth and then it just doesn't come through. So this is one risk. The next one, you need to understand this. It has to do with the earnings headwind, which is mathematically going to happen based off of the way accounting works. And people are not paying enough attention to this because they're quoting earnings multiples like I did at the beginning, where I said they're trading at 25 times trailing earnings, but then I also gave you the free cash flow multiple that was 46 times. That difference is gonna over time kind of converge basically for these reasons. And so I'm going to do a little bit of an overview of kind of the accounting of what's happening here. If you're familiar with it, go ahead, you could skip through this, but it's really important you get a good solid understanding of this. What happens when you buy a capital asset is it flows through the cash flow statement. So you spend, let's say, $80 billion on CapEx, like that's roughly what they're doing. That only goes through the cash flow statement. Now, how does it impact earnings if it's only touching on the cash flow statement? The idea behind depreciation is basically to allocate cost of a long-term asset in a specific period that actually it helps generate its earnings. And so this has to do in part with the matching principle, which is you have to have expenses match the period in which they help generate revenues. So you spent $80 billion on CapEx, that's going to help you generate some revenues. Well, how much? This CapEx I just spent $80 billion on, I think it's going to be around for many, many years. Let's say I think it'll be around for 5 years, which isn't that many, but let's just use 5 years for example. What you would do is you take that $80 billion in CapEx, you divide by 5 years, and then that will get you $16 billion a year, right? That $16 billion a year is going to be your depreciation. You are saying that I have $80 billion in CapEx that's going to help me generate revenues for the next 5 years. Since it's over 5 years, I'm going to allocate some portion of this CapEx cost to each of the next 5 years. So $16 billion a year. That's going to show up in my depreciation. This is important because as CapEx increases, depreciation lags. Right now, CapEx is running about 2 times ahead of depreciation. And so the amount of cost that is incorporated into the P&L right now is closer to 40 billion, even though CapEx is 80 billion. What happens is as they spend $80 billion or maybe even more over time, depreciation continues to increase. This is what will happen because that's just the way the accounting treatment works. The $80 billion they spent the last year, only 1/5 of it right now is flowing through depreciation. And then they have the prior year where they spent less, 1/5 of that is flowing through. The prior year from that, 1/5 of that is flowing through, and so on and so on. And so that is why depreciation takes a while to ramp up. Now, because of this, potentially earnings are overstated because we don't actually have the full cost it took to generate all of the revenues embedded in the existing income statement as expenses. And so the reason why I'm going through lengths to understand the difference between depreciation and capital expenditures is very often there's this idea that depreciation is going to be a proper sort of cost allocation of what the CapEx is. And if it's a proper allocation, then earnings are basically proper stated. But if it's understating though what the real maintenance CapEx is going to be, I'll explain that in a second, then what that means is that earnings are potentially overstated. So within CapEx, there's this idea of maintenance CapEx and growth CapEx. Really simple. Let's say you run Chipotle. You fix up all of the stores at Chipotle every 10 years. And you need to do that because no one wants to go to a Chipotle store that looks older than 10 years. So every 10 years, you have to redo all the stores. That capital expenditure, maybe you're spending 500 grand to fix the store. You'll say $50,000 a year. That is going to be maintenance CapEx basically. And that will then show up in depreciation of $50,000 a year. Now you have another sort of CapEx spend, which is growth CapEx. This is, let's open a new Chipotle store. I'm going to spend $1 million opening a new Chipotle store. That $1 million is growth CapEx. So the reason why an investor wants to understand the difference between maintenance CapEx and growth CapEx is the maintenance CapEx, we basically want to account for in existing expenses. Hopefully it shows up as depreciation, and it usually does. But when a company is growing CapEx very quickly, depreciation takes a while to catch up, basically, to match what maintenance CapEx could be. And so as a result of that, earnings can potentially be overstated. That's basically what's happening here right now. You could be very optimistic that all of the money they spend is going to eventually be able to be used and earn money and all that, but it still doesn't change the fact that right now they're only depreciating $40 billion a year, and it's probably a good portion more than that that is required to get the $305 billion of revenue they got last year in the last 12 months. Because they did, upgrade a lot of data centers with GPUs, and only a fraction of that expense is currently flowing through the P&L. And so what's going to end up happening is as CapEx continues to increase, depreciation is going to increase. That's going to be a headwind to earnings. That is just going to happen regardless of what your feelings are. It's going to be a headwind. Now, they could continue to grow revenues even more, and so you don't necessarily get margin compression. And on a dollar basis, you could still see earnings go up, but it's still going to be a headwind, something they have to work through. And so it's just something to keep in mind. By the way, it's the same thing for Meta. They have it even more extreme because they were very CapEx light before. So this is something to be aware of. That's going to be a headwind to earnings going forward. Now we'll talk about how we accounted for this in the valuation to get a real sense of what the business actually is generating in earnings today, taking into account this idea that some of the CapEx they're spending today is just to keep the ongoing maintenance of their existing business, to get the AI workloads that they're selling currently, right? And so let us now incorporate all that into the valuation. Right now, as of this recording, Microsoft is trading at a $402 stock price, a $3 trillion market cap. That's again, 25 times trailing earnings or 46 times trailing free cash flow if you back out stock-based comp. And of course, when you're looking at free cash flow, it's all the CapEx that's running through. So the difference in the real earnings of the business is a multiple somewhere in between there. It's somewhere in between that 25 times and 46 times. And we're going to make some assumptions on that. So the assumption we're going to make is basically half of the CapEx increase, only the half of the increase is going to actually be maintenance CapEx. And we want maintenance CapEx to be basically equal to depreciation. And because this is money the business has to spend every year just in order to keep their existing revenues, their existing cash flows. And so you make that adjustment, depreciation goes up a little bit. It goes up to about where CapEx was the year prior to last year. And that gets us a free cash flow multiple of 34 times. And so that to me seems about right. You could be more conservative, less conservative with your assumption if you want. But 34 times free cash flow, that's the number we're going to go with now. And then we're going to say, they've been growing mid-teens for pretty strong for a pretty long while. So let's assume they could continue to do that for just 3 more years. That will get us to a 22 times free cash flow multiple. At that point, if they could continue to grow low to mid-teens, you could put a 25 to 30 times multiple on it. So going 3 years out. And so just the range of valuation there, if you're taking that 25 times to 30 times, dividing by 22 times, is going to be 14% to 36% upside. And maybe you think things are going to be much better because they're so entrenched into businesses. Now they could do even more for them, and they're going to be able to knock out other software apps that used to exist. And AI agents are going to take that functionality, and Microsoft's going to get a margin on that. And it's going to be a long, long runway. And so maybe you want to put a higher multiple on that. Maybe you're concerned about some of the things we talked about. Maybe you don't think Microsoft is going to be the one to win AI. Maybe AI is commoditized, or maybe you're worried about some of the risks that we talked about here, and maybe you just don't think the return is quite there for your perceived risk. And to summarize, there's basically 5 things going on here. The first thing is that AI agents are cannibalizing the software business. They're leading that. They're doing that on purpose. The second thing is the platform as a service layer is now coming under competitive threat because of AI agents. This makes the cloud business have sort of different competitive moats because platform as a service used to be pretty sticky. Now AI agents threaten that. And so that's another thing that is kind of happening in the business. I'll put tucked into their infrastructure layers mattering more. Are you on GPUs, TPUs, maybe different chips that could come out in the future? The third thing has to do with an overcapacity build. Is this going to be a long-term overcapacity build or short-term? Maybe there won't be an overcapacity build, but you're going to have to take an opinion on that. The fourth thing has to do with that CapEx depreciation issue we were talking about. How much of this is going to be growth CapEx versus maintenance CapEx? Or maybe they're spending all this money just to stay where they are, to stay competitive, and it doesn't grow the business that much. Maybe it just ends up replacing their software business with an AI agent business that's now much more capital intensive. that would not be a great scenario for them. So an investor needs to keep all these things in mind because yes, it's Microsoft. If any company is going to be able to weather this transition, it seems like they're certainly in one of the best positions to do so, especially as it seems like AI models are becoming more and more commoditized, but there's still a lot of risk in terms of what the economics look like at the other end, and also what your time horizon is as an investor. If you are looking out 10 years, the risk is very different than if you're only willing to hold a stock for 2 years or 3 years. And if you also have certain expectations of earnings in the short term that don't end up happening, then you could be disappointed and you could get shaken out of the stock because you thought something that would happen that didn't happen because you weren't aware of all these issues. And the market may also not be aware of some of these issues, and so it may not be priced in. And so when you're dealing with technological transformation, there's certainly just a wide variety of outcomes that can happen. And I don't mean to be a bear or a bull in this scenario. I just want to describe a lot of different possibilities that could exist and help put the onus on you as an investor to see what you're comfortable with, to see what you think. Because when you're dealing with AI, this transformation is really impactful to a lot of different business models, and Microsoft is not alone. There are other businesses undergoing these crazy transformations, and we just did a video here on ServiceNow that you could check out, and another one here on Adobe, both software companies that are transitioning the business model in the face of AI. But if you enjoyed this video, go ahead and hit like and subscribe. And of course, if you have any questions at all, drop them in the comments below. Thank you for watching.